To understand the commercial space industry today, look at the engineering reality of SpaceX. By manufacturing reusable rockets and deploying a massive global satellite constellation, they have built an industrial moat that competitors are struggling to cross. But an exceptional, generation-defining company can still be a deeply flawed investment on day one. A great business is a terrible stock if you pay the wrong starting price. Let's look at the baseline. Current estimates suggest SpaceX generated roughly $15.5 billion in revenue and about $8 billion in EBITDA in 2025. Yet the rumored valuation for a potential initial public offering sits in an entirely different stratosphere. Reports indicate a possible IPO valuation reaching up to $1.75 trillion. This chart shows the jarring reality of those rumors. At a $1.75 trillion valuation, the market would be pricing SpaceX at roughly 113 times trailing revenue and 220 times trailing EBITDA. Buying in at those multiples means you are prepaying for a decade of flawless operational execution. It leaves zero margin of safety for any delays, accidents, or market shifts. Purchasing shares on IPO morning has very little to do with investing in space exploration. You are participating in a structurally engineered market event. Early buyers face three specific hazards. First, artificial price hype driven by limited supply. Second, a severe drop in share price when insider lockups expire. And third, a valuation model that ignores the intense capital constraints of building space infrastructure. To avoid being crushed in the early trading frenzy, a disciplined investor has to deconstruct the IPO mechanics and reverse engineer the math behind the hype. The price of a stock on IPO day is dictated largely by its float, the actual number of shares available to trade. IPO mechanics frequently create artificial scarcity that has no connection to the company's true value. Look at the rumored offering. Issuing $75 billion in stock against a $1.75 trillion valuation leaves a public float of just over 4%. Simultaneously, index providers fast-tracking this IPO will force immense passive capital to immediately buy into that tiny sliver. This structural bottleneck guarantees a massive price spike on day one. It is a supply constraint masquerading as price discovery. That scarcity premium has a strict expiration date. The Securities and Exchange Commission typically requires a 180-day lockup period for company insiders. When that window closes, the structure of the stock violently shifts. Millions of previously restricted shares flood the open market, instantly destroying the scarcity that propped up the initial price. Retail buyers who chase the stock on day one are structurally positioned as exit liquidity. They end up holding the bag when the supply dynamics inevitably reverse at the 6-month mark. Beyond the market mechanics, there is the operational reality of the business. Without a public S-1 prospectus, investors are currently operating in an opacity trap regarding SpaceX's true costs. SpaceX is viewed as a rocket company, but the data shows 50 to 80% of its actual sales come from Starlink's recurring telecommunications revenue. The physics of the satellite business are brutal. Orbital hardware degrades and the orbits. Maintaining a 15,000 satellite constellation requires massive, perpetual capital expenditures just to replenish the network. Factor in the immense R&D cash burn for the Starship platform, operating alongside the persistent risk of FAA safety groundings inherent to high-tempo launch schedules. This chart reveals the core financial illusion. Using a raw EBITDA metric to evaluate this business hides these structural aerospace costs and drastically overstates the true financial health of the company. Pricing SpaceX like an asset-light software firm is a massive miscalculation. It ignores the inescapable capital constraints required to maintain physical space infrastructure. Let's run a generous stress test on these valuations. If we project out to 2030 with a highly optimistic 22 times exit multiple, we can reverse engineer what you are actually paying for. Mapping the $1.75 trillion valuation against 2025 multiples reveals demanding wrath. A 2030 sensitivity matrix shows that assuming an absolute upper bound of 40% growth with 55% margins yields only $1 trillion. The $1.75 trillion rumor sits entirely off the chart. Requiring off-chart growth assumes zero resistance. It ignores incoming, well-funded competition from multi-orbit providers and aggressive broadband rivals deploying their own heavy infrastructure. Paying $1.75 trillion means you are pricing in flawless execution and total global monopoly dominance, completely discarding competitive physics and the hard realities of aerospace manufacturing. The ultimate question for an investor is not whether SpaceX is an incredible company. The question is how much of the next 10 years you are willing to prepay for on day one. For disciplined capital allocators, the primary recommendation is simple. Do not chase this stock on the day of its IPO. The first major catalyst to wait for is the eventual S-1 public prospectus. That document will finally cure the opacity trap and provide hard audited numbers. Inside that filing, you need to look for clean segment reporting that separates the launch business from Starlink. You need to see how the XAI subsidiary is treated, and you must verify the reality of their free cash flow conversion. The secondary catalyst is time. You must wait for the 6-month lockup window to expire so you can test how the stock responds to true market supply and demand. Patience is a strategic asset. By waiting, you remove the artificial market pressures and information blackouts that are specifically designed to separate retail investors from their capital. Let's establish the actionable valuation targets that long-term, disciplined compounders should look for once the initial hype fades. This graphic breaks down the discipline bands. Anything approaching the $1.75 trillion rumor is an emphatic avoid. Even the $800 billion private mark carries extreme mathematical risk, placing it strictly in the red zone. Below that is the watch zone, ranging from $350 to $500 billion. The stock only becomes interesting at these levels during a post-IPO sell-off or lockup-induced weakness. The genuine buy threshold sits much lower, near $300 to $350 billion. And even then, it requires a pristine S-1 filing and proven cash generation. Now, if you prefer strict metric-based guardrails, you should aim for an entry point where the enterprise value sits at roughly 18 to 22 times normalized 2028 EBITDA. SpaceX is undoubtedly an engineering marvel, worthy of admiration. But as an investment, demand hard numbers. Let the insider lockups expire and wait for market mechanics to work in your favor rather than against you.